So it finally happened. I finally got burned on a poor man's covered call. And in this video, I'm going to break down for you exactly what happened, how I resolved the situation, and then reflect a little bit on the strategy as a whole and how I would do things differently if I could go back in time. What's up, you guys? Welcome back to the Average Joe Investor channel. As you can see on the screen, we're looking at my Fidelity brokerage, and I don't have any more IWM poor man's covered calls. I had 9 of them before, and I also owned 300 shares of IWM. Things have changed quite a bit in the past 2 weeks. So I want to get into it right now, everything that happened, how I resolved it, and just reflecting on the strategy and how I would have done things differently if I could go back in time. So really quick, let me take you back in time here. Here's a look at my portfolio. I apologize for the small screenshot here. This is what my portfolio looked like on July the 8th, which was 2 days before things changed drastically. As you can see here, 300 shares of IWM, and then 1, 2, 3, 4, 5, 6, 7, 8, 9 different IWM poor man's covered call contracts. Now, before we dive into exactly what happened, just as a quick reminder here, a poor man's covered call is a variation of the traditional covered call strategy where normally you would own 100 shares of IWM and then you would sell a covered call option contract, which is covered by the 100 shares. With a poor man's covered call, instead of owning 100 shares, instead you purchase a call option that is deep in the money, meaning with a strike price far below the current market price and with an expiration date far into the future, at least 9 months to a year minimum. What this does is allow that contract to move in value very similarly to traditional shares of the underlying stock or ETF, and it allows you to then sell covered calls with far less capital. Now, the downside with the poor man's covered call contract is you can't just allow assignment because you don't actually own the underlying shares. You always want to roll your contract if it doesn't expire worthless. And what I've been doing is, with the 300 shares and with the 9 poor man's covered call contracts, was selling on a daily basis 12 IWM contracts, and then every day looking to roll that contract out to the next day for a credit, usually of about $150 to $250 depending on where market prices are. So let me break down for you exactly what happened here. What's up, you guys? You know, I've talked previously about Kalshi.com. It's a great website where you can make a wager, make a bet on potential future events happening or not happening. And I want to share with you again another example of a future event that you can actually make money on as an alternative potentially to hedge your bets in the stock market, or as an alternative to making money in the stock market. There are a lot of different events or markets potentially for wagering money here. You can see that, presidential debates, that's an interesting one. Whether the Fed's going to meet, what's going to happen with the Fed meeting in July. Is Congress going to be banned from trading stocks this year? That's very interesting. Here's an example of one that I like to look at myself, which is the federal funds rate, inflation, the Fed, because it could potentially act as a hedge against what we're doing in the actual stock market. So there's been a lot of news about whether there's going to be a federal funds rate cut in September as a result of inflation looking better. And so right now, there's what appears to be a 79% chance of a federal rate cut by September. And what you could do is take a contrarian view on this and say, well, I think that might happen, but just in case it doesn't, I want to be able to make some money in that scenario. So, for example, here you could say, well, since there's a 79% chance here, you could say, well, I don't think there is going to be a federal funds rate cut here. So I could select no, and you could bet, let's say, we'll call it 534, the remainder of my balance here. So let's go ahead and bet that right here. You just click on no, 21 cents, then you click review, and then you hit submit. Now in this situation, if there is a federal rate cut, I lose $5, right? That's the reality. But if there isn't, I make $18 on my $5. And you can see how this can get much more significant with more money bet here. So make sure to check out Kalshi.com to hedge your bets in the stock market, or to explore different ways to make money other than by selling options in the stock market. Check out the link down in the description below. Check out Kalshi.com today. On July the 10th, I had 12 contracts, and the contracts that I had, the different strike prices were staggered. There were 3 for one strike price, 6 for another, and 3 for another. And I was able to, of those 12 contracts, 3 of them I was able to close because they were far away from the market price. I was able to close those for $1 per contract. And that had happened earlier in the day, but being busy on my road trip, I got caught up in things. The market price had passed the other 9 contracts in value, and this was the first time I wasn't able to actually get in and actually roll the contracts, which I would have had to do for a debit, but regardless, I didn't get to it in time, and I got assigned. I got assigned on 9 contracts of IWM. And as a result here, go over to the screenshot here, you can see that I owned 300 shares at the time. Those 300 shares had a cost basis of $207. And the way that Fidelity had paired everything up, 3 of the contracts that I got assigned on were actually paired with these IWM 300 shares. So those got called away from me at a loss. And then the other 6 contracts were tied to poor man's covered call contracts. And so those 6 I got assigned on, but I didn't own the shares. So Fidelity still had to sell 600 shares to fulfill my obligation, which led to me being short 600 shares. So here's a screenshot now which shows what happened after the fact. So as you can see, I still own all of my LEAPS contracts, the poor man's covered call long positions, those call options I purchased, because there's no obligation that forces me to sell those or to request assignment on them to resolve the position. So you can see I own them all there, and you can see that under the IWM line it shows negative $122,022 in short, right over here, 600 shares. Now the reality is, when you are short shares, when I was assigned, I did receive as compensation for being assigned on those approximately $121,000. You can see that it's down here in the pending activity down here, because when I was assigned and I had to sell those shares, the buyer still had to compensate me at 300 shares for $202 price per share, and then 300 shares at $203. So you can see that the average cost basis is $202.49 or $202.50. So I did get compensation here, but I already was losing value here because as the price of IWM continued to go up, which, as we talked about, and as you're probably aware of, it did happen significantly. As a result, my short position lost more and more value because the short position gains value if the price drops. Now it's important, we're going to freeze here. If I had just right here, snapshot in time, this was before the spike. This was over the weekend here as this was happening. So this was right before IWM had a meteoric climb in value from 203-ish, 203.37 to about 207, 208, and then 212, and then 215, then 218. It was crazy. It was the worst time to get assigned. If I had just, the moment the market opened on Monday, resolved my position, it would have been a pretty small loss. Even if it had jumped to 207 by the time I closed, it still wouldn't have been that bad. But at this point, my thought process was, I'm going to let the market come back down, and then I'll be able to buy those shares back, resolve my short position at or below my market price. That was a mistake. Here's a look at the price chart for IWM, and we can see right here, this is where it ended at the market, and right here, where I got assigned right around 203-ish right here on 710, and then 711 was right in this range right here. The market popped up right as soon as the next day occurred, and I was sitting in this range, and I should have just bought back right in this range right here, but then it continued to go up. And then it was flat here, and I was still holding on, and it continued to go up and up and up and up here. And at this point, I was thinking I really needed to resolve my position, and it was starting to cause a little bit of angst because I was also trying to enjoy our family road trip. And at this point, I made a decision that I wanted to just resolve the position by buying to cover the shares, okay, and also selling my IWM LEAPS positions, because those had gained quite a bit of value with this pretty significant rise in IWM, and I was just going to get it all resolved out, net it all out, and then move on because I didn't want it to affect our road trip. And so I went ahead and did that, but I also opened new short positions to try and generate some additional cash, and those had been in the money as well because the market continued to go up and up, so I had to resolve those positions as well. So first, here's a breakdown. You're looking at my Discord where I share all this information real time with the community, and we were working through things because other people in the community were also managing these types of positions. This is where I liquidated my IWM LEAPS, sold them for a profit. I had 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, and you can see that there were pretty significant gains on some of those LEAPS options here. A gain of 522, 1425, 568, $3,000 right here on these 3 right here. Total gains by selling those positions was $6,760.49. Here's where I broke down buying to cover those shares. So remember, I was short them. In order to resolve a short position, you have to buy the shares to cover your position. So The problem, unfortunately, is I didn't start doing this at 207, 208. I had to do it at like 217, which was a significant loss. So as you can see here, 300 shares, I had a basis of 60 at 202 per share right here. So I bought 300 shares back at 217.42, which was a $4,626 loss. Then a 14.42 loss for these 100 shares. Then for these 150 right here, a 21.62 loss. These 8 shares at an $112 loss, and then the final 42 shares an $831 loss. So the total loss from buying to cover, because I waited so long to do it, was $9,175. And then my gains from selling my IWM Leaps positions was $6,760.49. So the net loss here, as you can see, $2,415.03. So that was how I netted out my position with respect to the capital of the shares to cover, and then also selling the Leaps. But I also had to buy back at a pretty significant loss the existing covered calls that were deep in the money that I had created here. So you can see here on the 11th, I had a loss of $3,198 right here, an additional $985 right here, and then the 1201 loss right here reflects the 300 shares that I had been assigned and taken away from me at a loss as well. So for the month, it's not looking great right now here in July based on when I made this video. It's going to be a negative month, but it's going to be the first negative month I had since December of 2023 running this cash flow strategy, and I'll net that out for you. I'll talk all about the end of the month results and how I've done overall since December, at the end of July, at the beginning of August. Big takeaways here, guys, for running the poor man's covered call strategy. Number one, don't get assigned. If you're going to run the poor man's covered call strategy, whether you use a daily covered call strategy, a weekly, monthly, doesn't matter, you can't get assigned. You have to always roll. And if you're going to be on the road, or if you're going to be on vacation, don't sell covered calls while you're gone. Big takeaway for me, I thought I could manage it. I got too busy. I neglected to manage the position in a timely manner, and it came back to bite me. That's the first big lesson here with the poor man's covered call strategy. Number two, if you do get assigned, just resolve it right away. Even if you feel like the loss is significant at the time, it could get much worse. Just resolve the position right away. Buy to cover, eat your losses. If it's a significant loss, you can always liquidate your Leaps options and start over at a future date. And the third big lesson here is there's nothing wrong with running a traditional covered call strategy, because while the poor man's covered call does give you a significant benefit where you requires far less capital to actually sell covered calls, it also takes away that easy option of just allowing yourself to be assigned above your basis if the market is going up. You don't have that option with the poor man's covered call, and for that reason, some people might choose to just stick with this traditional wheel strategy, which allows you to just get assigned and move on with your day. Hopefully you found some value from learning from my position with the poor man's covered call and what happened there. It certainly wasn't fun to lose money, but at the same time, tons of learning opportunities here. If you want to learn more about running a poor man's covered call strategy, or how to utilize the wheel strategy, make sure to check out the Average Joe Investor Patreon community. Tons of value there, learning from myself as well as other investors in the community who are also trying to create cash flow in their own portfolio. Also, if you want to book one-on-one time with me, you can do that through the Average Joe Investor VIP access and exclusive access tiers of the Patreon community. If you want to learn more, check out the link down in the description below. Hopefully you found some value in this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a brand new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.